Hello everyone, this week we are going to talk about the monetary system. First, let's start with barter. Barter is an exchange one good or service for another. For barter, you need to have double coincidence of ones, which unlikely happens that two people each have a good that the other wants. Barter is actually a waste of resources because people spend time searching for others to trade with. And using money solves these problems. Money is the set of assets in an economy that people regularly use to buy goods and services from other people. Money has three functions. First of all, it's a medium of exchange. That means you exchange money to buy goods and services. It's a unit of account. That means it measures the value. And it's a store of value. That means you can keep money and use it after 6 months. And these functions distinguish money from other assets. Medium of exchange, item that buyers give to sellers when they want to purchase goods and services. Unit of account, as I said, it's a yardstick people use to post prices and record debts. And it's a store of value, which is an item that people can use to transfer purchasing power from the present to the future. Let's see this example. You saved $500 in currency in your piggy bank to purchase new laptop. The $500 you keep in your piggy bank illustrates money's function as a store of value, because you keep $500 today and it still has a value after a period of time. The laptop's price is posted as $500. The $500 price illustrates money's function as a unit of account. So it shows the value of the computer. You use the $500 to purchase the laptop. This transaction illustrates money's function as a medium of exchange because you use money to buy goods and services. So money transfers power from present to the future. Hold money or non-monetary assets. But wealth is different, is the total of all stores of value, including both money and non-monetary assets. Liquidity is the key term for monetary assets. So what is liquidity? It's the ease with which an asset can be converted into the economy's medium of exchange. So we have two kinds of money. Commodity money takes the form of a commodity with intrinsic value. As you see here, gold coins or cigarettes in the prisoners of war camps are considered as commodity money because even if you don't use these commodities, they have a value. Gold has a value even if you don't use as money. Or cigarettes, the same idea. Fiat money, money without government intrinsic value, used as money because of government decree. And the fiat money, for instance, US dollar, it has a value because there is the signature of the government. Government accepts US dollar as the official money. If the government doesn't accept US dollar as official money, then these papers do not have any value. So let's talk about the amount of money in the US economy. Money stock is the quantity of money circulating in the economy. Currency refers to the paper bills and coins in the hands of public, which is non-bank. Demand deposits, on the other hand, are the balances in bank accounts that depositors can access on demand by writing a check. When we talk about the money stock, we have different definitions of money, and the categories of money starting from M1 to higher level is determined by the liquidity of money. So the most liquid money is in M1. And starting from M2, the money stock increases, but it becomes less liquid. So M1 is the most liquid. That means you can go and purchase anything you want with that assets. M1 includes currency, paper bills and coins, demand deposits like your checking accounts, traveler's check and other checkable deposits. And it is 3.8 trillion by July 2019. M2 is a bigger set. So this is M1, this is M2. As you see, M2 includes everything in M1, plus saving deposits, which are less liquid, small time deposits, money market mutual funds, and a few minor categories. So the key point here is that M2 is bigger, but it includes more less liquid assets. So the distinction between an M1 and M2 will often not matter when we talk about the money supply in this course. Let's see this example. Suppose the entire economy has $150 kept in coffee cans and wallets, $300 in saving account, $200 in credit card limits, $20 in traveler's check, $350 in checking account, $400 in money market mutual funds. Calculate M1 and M2. Let's start with the first one. $150 kept in coffee cans and wallets is both M1 and both M2. Remember, everything in M1 is also M2. $300 in saving account is only M2, it's not M1. M1 is a smaller set. 200 credit card limits is not a money, it's a debt. Okay, credit cards are debt, therefore it's not considered as money. You have to pay the credit card debt from your checking account, for instance. $20 in traveler's check is both M1 and M2. $350 in checking account is both M1 and M2. $400 in money market mutual fund is only M2. Now we can calculate M1. M1 is equal to 150 plus 20 plus 350, which is equal to $520. Now let's calculate M2. Everything in M1, 520, plus 300 in saving accounts, plus $400 in money market mutual funds, which is $1,220. Let's see this example. John and Jane decide to go on a vacation. As a result, they withdrew $2,500 from their saving account to purchase $2,500 worth of traveler's check. What happens to M1 and M2? $2,500 in a saving account is M2. $2,500 as a traveler's check is M1, but it's also M2. Right? Different form of M2. Therefore, M1 increases, M2 doesn't change. Next, we talk about Federal Reserve. The Federal Reserve, or the Fed, is the central bank of the United States. Central bank is an institution designed to oversee the banking system and regulate the quantity of money in the economy. Federal Reserve System consists of Board of Governors, which includes 7 members, 14-year terms, and located in Washington, D.C. Jeremy Powell is the chair of the Fed and appointed in 2018. In addition to that, there are 12 regional Federal Reserve banks located around the US, and one of them is in Dallas, Texas. So what are the Fed's jobs? First, Fed regulate banks and ensure the health of the banking system. Fed monitors each bank's financial condition, facilitates banks' transactions, clearing checks. It's a bank's bank, makes loans to banks, and it's the lender of last resort. Second, it conducts monetary policy, and monetary policy is conducted by FOMC. Control the money supply, which is the quantity of money available in the economy. FOMC is composed of 7 members of the Board of Governors and 5 of the 12 regional bank presidents. All 12 regional presidents attend each FOMC meeting, but only 5 get to vote. FOMC does open market operations, or in short OMO. That means buying US government bonds to increase the money supply and selling US government bonds to decrease money supply. The next topic that we talk about are the bank reserves and how banks create money. Before we start to learn about how banks create money, we have some couple of definitions that you need to know. The first one is fractional reserve banking system. Banks keep a fraction of deposits as reserves and use the rest to make loans. The Fed establishes reserve requirements, which are the regulations on the minimum amount of reserves that banks must hold against deposits. Banks may hold more than this minimum. Reserve ratio, or R, is the fraction of deposits that banks hold as reserves, which is equal to total reserves as a percentage of total deposits. Banks use T-account. T-account is a simplified accounting statement that shows a bank's assets and liabilities. Now you see that T-account divided into 2, assets and liabilities. So bank liabilities are the ones that the bank is liable to pay back. And bank's liabilities includes deposits. When you deposit money to the bank, banks have to pay you back this money whenever you want to withdraw. Assets include loans and reserves. That means these are the things that banks own. Reserves, as I said, is required by the Fed, and loans are the ones that banks are giving as credit to the public. Here, in this case, the reserve requirement ratio is 10%. How do we find? Reserves are $10 and deposits are $100. So reserves are 10% of all deposits. Remember, R represents the percentage of the reserves compared to total deposits. Let's see how banks create money with an example. Suppose 1,000 of currency is in circulation. To determine bank's impact on money supply, we calculate the money supply in 3 different cases. If there is no banking system, 100% reserve banking system. That means banks hold 100% of deposit as reserves and they make no loans. In that case, banks behave like safe bucks. And finally, fractional reserve banking system. That's what we have today. And the reserve requirement ratio is 20%. That means each dollar deposited to the bank, 20% of it has to stay in the bank in the reserve. No banking system, public holds 1,000 as currency, so the money supply is equal to $1,000. Let's see now 100% reserve banking system. Public deposit this $1,000 at First National Bank. Now the money supply is still 1,000, just the form of money has changed. Before, public has currency, now it's a demand deposit. So First National Bank holds 100% of deposits as reserves. Money supply, currency plus deposits, 0 currency, but 1,000 demand deposits is equal to $1,000. In a 100% reserve banking system, banks do not affect size of money supply. Now let's see fractional reserve banking system, and R is equal to 20%. FNB loans all but 20% of the deposit to Isabella. So what happens is that this is the T account of the FNB. Deposits 1,000 and 20% reserve requirement ratio says that you have to keep $200 in the reserve and the bank can lend $800 out. Depositors have now 1,000 in deposits. Isabella, the borrower, also has $800 in currency. So what happened to money supply? Currency is 800. Isabella, the borrower, can use. And also depositors deposit 1,000 here. You see, money supply suddenly increased to 1,800. How did money supply suddenly grow? The answer is easy. When banks make loans, they create money. Isabella, the borrower, gets $800 in currency, an asset counted in the money supply. $800 in new debt, loans, is a liability that does not have an offsetting effect on the money supply. Therefore, a fractional reserve banking system creates money but not wealth. So when Isabella pays the loan back, money destroys backward. Because now $800 turn back to the bank and then the money is destroyed. So let's continue with that example. Isabella deposits this $800 at the Second National Bank. So SMB's T account looks like this. The deposit is $800 and now 20% reserve ratio, 160 should stay in the reserves of Second National Bank. This bank can lend $640 out to the public. And in this case, we continue to create money. Kerem, which is the borrower from Second National Bank, deposits this $640 at Third National Bank. So Third National Bank's T account looks like this. Deposits 640 and then reserves 640. But you know that Third National Bank should keep only 20% and the remaining could be lent out. If R is 20% for TNB, it will loan all but 20% of the deposits to Dahlia and its T accounts will change to reserves 128 and loans 512. So this process continues and the money is created with each new loan. Original deposit is 1,000, then First National Bank lends 800, Second National Bank lends 640, Third National Bank lends $512. And at the end, by this process, by lending money out through the banking system, total money created is $5,000. So in this example, $1,000 of reserves generates $5,000 of money. Is there a short way to find total money created through the banking system? Yes, there is. We need to use money multiplier to find out the total money supply created through the banking system. Money multiplier is equal to 1 over R. R, if you remember, is the reserve requirement ratio. So money multiplier is the amount of money the banking system generates with each dollar of reserves. It is the reciprocal of the reserve ratio. The higher the reserve ratio, the smaller the money multiplier because the less of each deposit banks loan out. Let's see this example. While cleaning his apartment, Hakim finds a $50 bill under the couch. He deposits the bill in his checking account at Chase Bank. The Fed's reserve requirement is 10% of deposits. First question is, what is the maximum amount that the money supply could increase? Second question, what is the minimum amount that the money supply could increase? And the third question is, how would your answer to A and B change if reserve requirement ratio is 5%? Let's start with the first one. R is 10%. Hakim deposits $50 in his checking account. Maximum increase in money supply if banks hold no excess reserves, then money multiplier is 1 over R. And here, be careful, you are going to use in decimal form the R. 1 divided by 0.1, because 10% is 0.1, is 10. The maximum possible increase in deposits is 10 times 50, which is $500. But initially we have the $50, which is the currency. Therefore, maximum increase in money supply is $500, which is the total money supply. Subtract the 50 initial currency, $450. How about the minimum increase in the money supply? Answer is $0. If Chase Bank makes no loans from Hakim's deposit, currency falls by 50, deposits increase by 50, money supply doesn't change. When banks hold all deposits in reserves, banks do not influence the supply of money. How about if R is 5%? Hakim deposits $50 in his checking account, and we will find out maximum and minimum increase in money supply if R is 5%. If R is 5%, money multiplier is equal to 1 over 0.05, which is 20. If banks hold no excess reserves, the maximum increase in money supply is going to be 20 times the $50 minus the initial 50, which is $950. If banks keep all deposits in reserves, the change in money supply is going to be 0. So that means Hakim depositing the money to the bank creates a demand deposit, so the form of money changes from currency to demand deposit, but no new money is created. Let's see more examples. Assuming the Bank of Springfield and all other banks have the same reserve ratio, then what is the value of the money multiplier? So remember, reserve ratio is equal to reserves divided by total deposits. And times 100 to find this number as percentage, which is equal to 11%. So the reserve ratio for this banking system is 11%. Let's see other questions. A bank's reserve ratio is 8% and the bank has $1,000 in deposits. What is its reserves? Reserves equal to 8% times 1,000, which in this case, $80. A bank has $500,000 in deposits and $475,000 in loans. It has loaned out all it can. What is the reserve ratio? Let's first draw the T account. Liabilities, assets. Deposits are $500K. Reserves we will find out, and loans are $475K. And we know that this is an accounting statement. Assets are equal to liabilities. If this side is $500K, this side should be in total $500K too, so therefore reserves are $25K. And reserve requirement ratio R is equal to $25K divided by $500K times 100, which is equal to 5%. A bank has $8,000 in deposits and $6,000 in loans. It has loaned out all it can given the reserve requirements. What is its reserve requirement? Again, we can draw the T account. Liabilities and assets. Deposits are $8,000. Loans are $6,000. We need to find the reserves. reserves, remember, assets are equal to liabilities. Therefore, reserves are 2,000. Now let's find reserve requirement R. 2,000 divided by 8,000 times 100. In this case, R is equal to 25%. Let's see this question. An economy starts with $50,000 in currency. All of this currency is deposited into a single bank, and the bank then makes loans totaling $45,750. The T account of the bank is shown below. Here. What is the bank's reserve ratio? Same idea, reserve ratio is the reserves 4,250 divided by 50,000 times 100. In this case, it's equal to 8.5%. The next question is, if the bank is holding 4,000 in excess reserves, then what is the reserve ratio? So sometimes banks keep more reserves than it's required. Here, in this case, reserves account totals to 30,000, but 4,000 is excess. So that means the required reserves are 26,000. And now we can calculate the reserve ratio. Reserve ratio, in the numerator you should include the required reserves, not all reserves, required reserves. Required reserves are the ones that you subtract the excess reserves from the reserves account. And deposits are 200 times 100. So now R is equal to 26,000 divided by 200 times 100. And in this case, 13%. So let's look at a more realistic balance sheet. Assets, as we said, includes reserves, loans, but also securities. Bank securities include stocks and bonds. Liabilities includes deposit, but also includes debt and equity. Bank capital, which is owner's equity, are the resources a bank obtains by issuing equity to its owners. It equals bank's assets minus bank's liabilities. So equity is equal to assets minus liabilities. Leverage is the use of borrowed funds to supplement existing funds for investment purposes. Let's see more realistic T account. Assets, we have reserves, loans, 1,000, and securities, stocks and bonds the bank holds. On the liability sides, we have deposits, debt, and the capital, which is owner's equity. Here, let's look at what is the leverage ratio. Leverage ratio is assets divided by equity, in this case $2,000 of assets divided by 100, which in this case 20. So what does that mean? That means for every $20 in assets, $1 is from the bank's owners and $19 is financed with borrowed money. If bank assets appreciate by 5% from 2,000 to 2,100, bank capital increases from 100 to 200, doubling owner's equity. If bank assets decrease by 5% from 2,000 to 1,900, bank capital falls from $100 to $0. If bank assets decrease more than 5%, bank's capital is negative and bank is insolvent. Insolvent means you don't have enough assets to be able to pay back your liabilities. Capital requirements is a government regulation that specifies a minimum amount of capital intended to ensure banks will be able to pay off depositors and debts. Financial crisis of 2008-2009, banks find themselves with too little capital to satisfy capital requirements, and this created a problem, credit crunch, which is the shortage of capital induced the banks to reduce lending. And next we are going to talk about Fed's tools of monetary control. In fractional reserve banking system, banks create money and the Fed's control of the money supply is indirect. So money supply is equal to money multiplier times bank reserves. The Fed can change the money supply by changing the quantity of reserves and by changing the reserve ratio and the money multiplier. So you can either change this section or you can change this section or both to control the money supply. The first tool that Fed uses to control the money supply is open market operations. Open market operations is the purchase and sale of US government bonds by the Fed. To increase banks' reserves and the money supply, the Fed buys government bond from a bank. So what happens is that this is the bank, this is the Fed, and Fed is buying government bonds. These are piece of paper, right? Government bonds. And in return, Fed gives money to the banks. So pays by depositing new reserves in that bank's reserve account. With more reserves, the bank can make more loans, increasing the money supply. So let's see this example. Federal funds market, federal funds rate. Federal funds rate is the interest rate where banks borrow from each other overnight. If Fed wants to raise the federal funds rate, Fed sells government bonds. In that case, there will be less reserves in the bank. Think about this way, Fed and bank. Now the Fed, by selling government bonds, gives piece of paper, government bonds, to the banks, but in return gets currency, money, back. And now banks are holding government bonds, but they are not having reserves as before. This removes reserves from the banking system, therefore the supply shifts to the left, reduces supply of federal funds. Because of having less reserves, now banks need to borrow from each other. When they want to borrow from each other, the federal funds rate increases. So the federal funds rate is the interest rate at which banks make overnight loans to other banks. The lender has excess reserves and the borrower needs reserves. Decisions by the Fed or FOMC to change the target for the federal funds rate are also decisions to change the money supply. A decrease in the target for federal funds rate means an expansion in the money supply. Here you can see the federal funds rate and other interest rates because there are other interest rates in the economy, but they follow the federal funds rate. Here effective federal funds rate is the blue one, and immediate rates less than 24 hours, prime rates for the United States is the red one. They are closely following the federal funds rate. 3-month treasury bill, 30-year fixed rate mortgage loan all follow very closely the federal funds rate. So by changing the federal funds rate, actually the Fed is targeting to change the money supply, therefore affecting all the interest rates in the economy. There are other tools that Fed can use to change the money supply, and one of them is discount window. Banks borrow from Fed's discount window and they pay an interest rate called the discount rate, increasing reserves in the banking system and increasing the money supply if the discount rate goes down. So if borrowing is cheap, what happens is that banks borrow from Fed at a cheap rate, and this is called discount rate. When Fed decreases this rate, actually Fed is increasing money supply by giving cheap loans to the banks. So if the Fed lowers the discount rate, encourages banks to borrow more, increasing the quantity of reserves and the money supply. And in the reverse case, if the discount rate is higher, Fed is actually targeting less money supply in the economy. Another tool that is used during the financial crisis is term auction facility. Fed sets a quantity of reserves it will loan, then banks bid against each other for these loans. The Fed lends to banks not only to control the money supply, but also to help financial institutions when they are in trouble. Between 2008 and 2009, a fall in housing prices throughout the US leads to sharp rise in mortgage defaults, and many financial institutions holding these mortgages ran into trouble. The Fed provided many billions of dollars in loans to financial institutions in distress. And the next monetary tool that Fed uses is the reserve requirement. Fed sets the reserve requirements. Reserve requirements are the regulations on the minimum amount of reserves banks must hold against deposits. Reducing reserve requirements would lower the reserve ratio and increase the money supply. So if the reserve requirement R is 20% and Fed lowers to 10%, money multiplier in the first case is 5, money multiplier in the second case is 10. So as you see, with a lower money multiplier, you create less money. And another tool that Fed does to increase or change the money supply is paying interest on reserves, and it started by financial crisis of 2008-2009. When banks hold reserves at the Fed, raising this interest rate would increase the reserve ratio, lower the money multiplier, and lower the money supply. So let's see some examples. If the Federal Open Market Committee decides to decrease money supply, it can sell government bonds. Purchasing corporate bonds, Fed does not do that. Purchase government bonds is going to decrease money supply. Reducing interest rates are actually going to increase the money supply. Let's see this one. When the Fed sells government bonds, remember Fed now is selling bonds, a piece of paper, to the banks. The money supply is not going to increase. The money supply is going to decrease because banks are going to give money to Fed. So the money supply is going to decrease. Now let's understand what happens to federal funds rate. When money supply decreases, there are less funds to borrow from each other. The banks, Bank A, Bank B. So the banks have less funds to borrow from each other and the money becomes scarce. When money becomes scarce, the interest rate, the rate that they borrow overnight, increases. Therefore, federal funds rate is going to increase. There are problems in controlling the money supply. Fed does not control the amount of money that households choose to hold as deposits in banks. So Fed maybe increase the money supply, but we don't know whether the public are going to deposit the money in the bank. The amount that bankers choose to lend also cannot be affected by Fed. The bankers might see that the economy is very risky and they stop lending money. Yet the Fed can compensate for households and bank behavior to retain fairly precise control over the money supply. A run on banks. If people suspect their banks are in trouble, they run to the bank to withdraw their funds, holding more currency and less deposits. Under fractional reserve banking, banks do not have enough reserves to pay off all depositors. Banks may have to close. Also, banks may make fewer loans and hold more reserves to satisfy the deposit. These events increase R, reverse the process of money creation, cause money supply to fall sharply. And that happened in 2007, bank run in the UK. Northern Rock Bank was eventually taken over by the British government. During 1929 and 1933, a wave of bank runs and bank closings caused money supply to fall 28%. Many economists believe this contributed to the severity of Great Depression. Since then, there is Federal Deposit Insurance, FDIC, helped prevent bank runs in the US, a more stable banking system. So Federal Deposit Insurance is an insurance on your bank deposits that you are not going to lose if bank runs. And this is the end of this chapter. Thank you.